So let's get a pulse of the audience. How many founders in the audience? Okay, I see one hand there. How many go-to-market leaders? Okay, how many consultants? Okay, a few. All right, so we have the next half an hour, a power-packed session here, where we're going to explore what do investors look for in GTM. As they are investing, helping startups scale, we're looking to cover a few topics on the core GTM, as well as some of the pricing models, some of the SaaS models evolving to AI now. So we'll talk about all that. But before we get started, I'd love to introduce myself. My name is Preethy Padmanabhan. I'm an executive in residence at Emergent Ventures. I'm also a fractional CMO. I'd like to pass it on to Priya.
Hi, folks. My name is Priya Saiprasad. I'm one of the co-founders of a firm called Turing Capital. We launched about 2 years ago, and we're focused almost exclusively at investing at the intersection of AI and software, predominantly at the application layer. We love companies typically in that early growth inflection point, so typically between 3 to 10 million of ARR is our sweet spot, and our team has actually worked together for almost a decade across different platforms now.
Anupam?
Hi, everyone. My name is Anupam. I'm a managing partner at Emergent Ventures. We are a seed stage venture firm focused exclusively on enterprise AI solutions that are adopted by enterprises. And our model is to lead rounds in a few companies every year and really help them get to product market fit, build out go-to-market, and then off from there sort of scale their companies. And after which, some of the larger investors come in and invest. I've been in the venture space for the last 15 years, and then before that, I was in go-to-market and product roles at a couple of startups. Looking forward to the conversation here.
Ashmeet?
Hi, everyone. Ashmeet Sidana from Engineering Capital. I started the firm about 10 years ago, and I am a solo GP. I work alone, specializing in leading pre-seeds, seeds in software companies that are taking high technical risk. That's why I call it venture capital for engineers. Happy to be here.
Thank you. So we'll start with Anupam for the first question. As you're evaluating companies for go-to-market strategy, how do you determine what are the right strategies for scaling, product market fit? Would love to hear your perspective.
Yeah. So we are at Emergent investing very early at pre-seed or seed stage. Often the founder may have they have an idea, and then sometimes they'll have some pilots going on. Some other times they have some early revenues. So at that stage, what we're really looking for is the level of clarity on the go-to-market side, which includes who's the buyer. So that would be the ICP, what kind of companies, perhaps what's the size of companies, geographic mix, who's the buyer, specifically who's the champion, who are the stakeholders, who are the users, some clarity around that, some thesis on where they think the product might fit as they get to customers. Of course, at the time we are investing, it's very early, so those things may change as things evolve, but we're looking for some level of clarity based on work that they've already done. They may have often, a lot of founders that we talk to who are sophisticated, they've gone and talked to 50, 70, 100 different people in their buyer or customer persona, and they've built a sense of who their prospective customers are, and also who their prospective customers aren't, and where the product is likely to work, what's the wedge likely to be, and then what might be their long-term form factor for their product. So we're looking for that clarity on the go-to-market side. Often it's a little bit too early to have a full-fledged go-to-market strategy. A lot of the founders we work with are technical, but many of them we are filtering for folks who are able to build that muscle on the go-to-market side. So they have often gone and spent a few months talking to prospective customers. They've built a sense of how things are going to work out. And then we are often comfortable taking that risk of and work with them on really helping figure out the specific strategy and tactics.
Yeah, no, fantastic. I think I heard clarity of ICP, talking to customers. These are all very critical. I think for any role, any of us need to have that clarity. I'd like to take a different angle with you, Ashmeet, because you mentioned that you invest in technical founders, and sometimes technical folks are not exactly the ones who might have the strength in GTM. So if somebody comes to you with a certain go-to-market, how do you determine between something that's just a vision versus that can actually be executed and be successful?
Yeah, so sometimes people have the misconception that just because you're a technical founder, you don't have to sell, or you perhaps don't even have or need the sales skills. Reality is, go-to-market is one of the most important functions in your company. There is no product that sells itself, and you have to have a plan for how you are going to bring it to market. Depending on the type of company, and I have companies in both examples, you are either selling a solution to a known problem. In other words, people understand the problem, they know they have the issue. Perhaps there are some incomplete or insufficient solutions that work in it. And over there, you would use what I would call traditional go-to-market techniques in terms of how the customers have already accepted whatever that market is that you're operating in. Sometimes, in a small subset of the cases, you come up with companies where people don't even know they have the problem, because you truly have something fundamentally new, something different enough that you can think of it as a core invention. In which case, you have to really think about go-to-market from scratch. Now you have to start with effectively education. How are you going to educate people that there is an opportunity to solve this problem that they don't even know they have using this new technology that you've built? And that's often a conversation I will have with founders early on. And that's a conversation that doesn't end just when you're a startup. That can continue with companies that have 10 million, 100 million, even $1 billion in revenues. And I have companies at all of those stages in my portfolio. You are often having that conversation. What is the best way to educate, then show the value, demonstrate the value proposition, attract the customer, and then obviously close the customer?
No, what I'm hearing again, Ashmeet, is that you have to consistently keep working at it even as you grow the company, for sure. Priya, let's talk a different angle, which is the red flags, right? As you're looking at companies, evaluating them, what are some red flags in go-to-market? I like to say the product looks amazing, but what do you look for as red flags?
Yeah, it's a good question. So we typically invest at the Series B stage, so a smidgen more late stage than I'd say both of you. And what we look for at that stage is not perfect go-to-market by any means, because your ICP is actually still evolving. You're learning a lot more about that. And typically your pricing model is evolving as well. So we definitely don't look for perfection, but we look for the clarity word that you mentioned earlier really comes to mind. We look for, do you fully understand your ICP? Do you fully understand your sales cycle from start to finish? How long is the sales cycle? How many constituents in an enterprise, if you're selling into an enterprise, are involved in that sales cycle? Do you have POCs? What do the conversion rates look like on those POCs? We want to see sort of this end-to-end process there. And in terms of red flags that we look for, sometimes we find a crop of incredible product-driven companies that want to have almost a hybrid go-to-market strategy where it's, let's do it all. Let's have top-down enterprise sales where we go out there, we hire an entire sales team, and we go into the enterprise and sell. And then let's also have our product have inherent viral loops built into it. And let's do a product-led go-to-market motion as well. Let's see what sticks. And that usually is a pretty big red flag because the value proposition and the ROI is fundamentally different across both. The type of buyer and why they purchase your solution is also vastly different. And also the capital efficiency of both go-to-market motions, again, wildly different, right? So are you hiring an entire enterprise sales team, account managers? Are you hiring all these reps when you have a product-led growth motion? So sometimes I find that really conflating. And the last thing I'd say is, we're in a new wave of AI native software companies, and so the pricing model is vastly different than what software and standard SaaS pricing model used to be, right? It used to be annual recurring per seat per user, and typically if your AI is actually delivering value, you will need less seats to consume that AI in the future, right? So inherently, if your product's doing well, you will have contraction year over year versus upsell. So with that in mind, how do you redefine pricing? And how do you align that pricing goals with your end customer and the value that you're driving to them? So of course, everyone talks about consumption-based pricing models, and I find founders pitching that to us consistently. The thing that's that requires at the Series B stage in particular a little bit more clarity on is, okay, fine, it's consumption-based initially, usage-based. Is it going to stay usage-based? Is it going to shift towards an outcome-based approach where you generate an ROI and then you do a take rate off of that ROI? What does the path look like for that evolving pricing model? Having a sense of clarity in discussing that with a VC, I think, is very helpful.
Lots of nuggets there.
You know, Preethy, if I can jump in and just add one other thought to that. Traditionally in the software industry, we haven't worried too much about the gross margin of the product. You obviously always worry about the net margin and sort of your cost of getting the product to market. But the gross margin was never an issue because software was effectively free. The cost wasn't that much, and depending on how you're delivering it, even in a SaaS company, it was never a true driver of your business model. With AI, that has changed dramatically. We now have AI products where the costs can be very significant, especially if you're dependent on, for example, a third-party LLM. You could be spending an enormous amount of money just to service your customers. And so understanding what is your business model that allows you to align your costs is a very important consideration in your go-to-market. I can give some examples if people want to dive further into that.
No, that's great thoughts there. Actually, I wanted to get a sense here. How many of you are product-led growth companies? Any by show of hands? Are one, I think. And then sales-led growth? A few hands. Channel-led growth? Yeah? A few? Yeah. So, yeah, it is certainly all these different models of going to market. And like what we heard, right, everything is dependent on what is your customer base and where are they located and how do you get them effectively. I'd like to ask you, Anupam, in this whole AI-based SaaS era that we live in, right, where we've moved from SaaS to AI models, can you talk about, like when you look at product-led growth versus sales-led growth companies, what do you prefer in terms of investing? Do you have a certain direction that you look at?
Yeah, so I'd say a lot depends on the specific product that you're building and who the customer is, because different products and form factors lend themselves to different go-to-market motions. So if you take the three, product-led growth, sales-led growth, channel-led growth, eventually if you look at the companies that scale really fast in the enterprise, many of them leverage all three really well. So they have a hybrid motion at some level. Many companies, not all, but many do at the growth stage. But the early stages, it's really hard to have multiple motions working at the same time. I'd say, the sales-led motion is the more predictable of the three. You put in X, you get Y. If you're doing it well, you can get to that stage where you say, hey, we have these many salespeople, these many hours on sales that are being spent, and we can generate this much revenue. So you can get to that stage. Product and channel tend to be much more of step jump oriented, where you're really rolling the boulder uphill up to some point, and then if it takes off, you can have very nonlinear growth. Channel is really hard or really rare to see that work at the stage we invest at. There are exceptions in our portfolio, maybe there's one or two, which use or leverage channel to get off the ground. But with channel, the thing is, hey, if someone has a lot of distribution, why they're going to choose to work with you, a company with no track record? They would choose to work with someone who already has 20, 30, 50 customers, and where it's proven, they don't want to take that risk. So at that stage, channel becomes really interesting. So then that leaves you with product-led and sales-led, and I'd say, a lot depends on the function. So there's some functions, like, for example, if you're building for customer service or finance, product-led is really hard. Finance people don't just download stuff and connect it to the ERP or the finance system and start running analysis on it, right? Whereas maybe in marketing, or if you're building something for engineers, those may lend themselves to, depending on what you're building, to product-led growth. So we take that into account, and we spend a lot of time talking to folks in the buyer and user persona to understand how is their buying process, what are the controls around security, privacy, governance, where the budget's coming from, are the individuals empowered to actually start using and buying these products if it's a product-led model, which in a lot of functions is rare. In some others, that's the de facto model. So I'd say matching it with how your buyers and users are consuming software is the key, which is what we are looking for.
Yeah, no, that makes perfect sense. You might want to think of what questions do you have. We'll do one more round of questions and open it up for audience questions. Let me go to Ashmeet. You talked about how founders have to evolve their go-to-market models as they grow, but you're investing early, right? How do you assess the ability of the founder and the executive team to evolve the GTM models? What are the signals of adaptability and the long-term thinking? I would love to hear your thoughts on that.
Yeah, this is a really interesting question because especially at the early stages, there's very little hard data to work with. By definition, when I'm making an investment, there are no customers, there is no product, there is no gross margin, there are no financials that you can really analyze in a traditional sense. And so everything that we are doing is an extrapolation. It is a belief about what will come in the future, and the best indicator of what will come in the future is actually your ability to learn, your ability to adapt, your ability to change, because the market changes very quickly. 2 or 3 years ago, nobody was talking about AI in the way we are today. Every single company today has had to reinvent itself in the age of AI. And so for me, that's a subjective opinion. It is a judgment about the individual, their desire to learn, their willingness to learn, and their flexibility, while having a foundation of education, of experience, of domain knowledge that they can draw upon to help them to grow rapidly and to be able to take the best advantage of whatever the future holds. The future is unpredictable. That is just a fact of life, and we have to keep learning.
Mm-hmm. Yeah, no, that's actually, I think that's relevant for anybody. That's a great message there. Priya, I'd like to ask you more about go-to-market narrative and storytelling. Would love your perspective because we have a lot of go-to-market leaders here. How important is storytelling when it comes to building companies, building startups, and what you look for in them?
Yeah, this is a great question because I've sometimes chatted with founders where they have a separate story and separate narrative that they put together for their customer base, and then they have an entirely separate narrative and storytelling for their investor base. And a lot of times it's actually vastly different, which is somewhat scary and shocking. So I love when you have one narrative, but that narrative aligns with multiple different stakeholders and constituents, right? It's simpler across all parties, and that narrative is very ROI focused. First of all, what is the problem that you're solving? Why is this a radically important problem out there? Are there any tailwinds in the industry that are really helping make this problem even more profound, such that your solution is absolutely necessary, right? And who is the buyer in this space, and who's the user? Sometimes the buyer is not the same as the user. A lot of times it's not the same. And so how is the value generated across each stakeholder in the enterprise? And then being able to succinctly communicate that while at the same time understanding that the expectations from your end customer is vastly different from the expectations of the investor, right? Because the running joke is everything has to have a sprinkle of AI native on it in order to get a heavy valuation. So even if your company isn't necessarily AI native, you might want to position the go-to-market strategy with some AI pixie dust, right? The reality is, even as VCs, we look for what is the problem that you're solving. AI is one tool and one vector through which you can solve that problem. But ultimately, we still love understanding what that customer pain point is, how that comes alive, and how your solution is somewhat unique in going after that, right? Or the market leader, et cetera. So I think storytelling is actually everything, but having a concise, succinct storytelling that leverages some of the industry trends and helps accelerate your product and bring the vision alive to the end user, more important than it's ever been. Because also, from our perspective, in every category of software, there's now starting to be, call it 10, 20, 30 companies. So sometimes, yes, of course, the product differentiates itself, the go-to-market strategy differentiates itself, but a lot of times it's actually articulating that differentiation that makes all the difference.
Absolutely. And do you also see some founders come to you with customer responses and maybe even bring the customers?
Yeah, absolutely. I mean, we do very in-depth customer reference calls, and usually not the ones that the founder refers us to. We like to do our own outside in as well. But almost bringing alive those customer reference stories, like why did they make the purchase in the first place? But more than that, why will they continue renewing with you? Because in the AI native era of startups, just as as easy as it is to scale your company from 0 to 10, it's also actually pretty scary, the churn rate and the lack of stickiness, because there's a general sense of excitement among large enterprises in wanting to try out AI tools. And so it comes out of a corporate innovation budget when they sign you up. But then year 2 and year 3, year 4, 5, et cetera, comes out of actually the business unit budget. So you have to demonstrate value in less than a year in order to consistently prove that retention. And so that's definitely something we look for.
Absolutely. Before I open to the audience, do you want to add anything, Anupam? We can open it up. Okay, let's open it up to audience questions. Okay, I see one hand there. If there is somebody who can get a mic to, perfect. Thank you, Ryan.
I loved your last point about articulating that differentiation and that being completely separate from go-to-market and product. My question's focus is specifically on pricing. We've gone through many panels, and my hypothesis and my partner Natalie's hypothesis is some of these are falling short because of that communication of value when speaking to the pricing. So I was curious, what have you seen as the way that you speak to your founders, the best way to get them to get over the hump of having created the perfect pricing and then actually communicating that value, especially when we are in a time when there's a lot of experimentation around pricing. And so it's hard to continue to refine the story that's changing as you go. So I'd love to hear your thoughts.
Anybody can go.
Yeah, I'll jump in and say that there's no such thing as a perfect price. A price is a compromise that is set, is at least in the traditional sense where we have fixed pricing, which is not a negotiated agreement between the buyer and the seller. The negotiated agreement price typically happens only in very large deals. It's very expensive to do, and it doesn't make sense for most products. For product-based pricing, where we almost always have fixed pricing, it's a compromise. It is an estimate of the value that we are creating for which the customer is willing to pay, and you have to express that as a single number. So you've decided, to compromise on that number, and it will never be perfect, but hopefully it's good enough and it's attractive enough that the customer will purchase it.
I might add on to that by saying, being able to communicate to your customer, ultimately, this is the value that we are driving for you. This is your core ROI. I actually find that a lot of entrepreneurs sort of fail in some cases in convincing what that ROI is because they're so focused on just solving that pain point, maybe that workflow optimization or yet another feature, but it's actually communicating what that ROI is and then saying, almost reframing it in the mind of the customer by saying, we're just taking a tiny little take rate of this ROI that we're generating for you, and it's an outcomes-based pricing. Now that's a lot easier said than done because in order to actually generate that ROI that's quantifiable, you need the customer to onboard onto your solution, which usually takes quite some time, and then to actually use it, have that engagement with it. So it usually takes at least a year for you to be able to generate that ROI. So that's why I'm now starting to see a trend, and we advise a lot of our founders to start with an initial usage-based pricing, right? And then eventually, but you articulate that usage-based pricing by saying this is an incredible amount of ROI that we will be generating for you in the future. We're actually underpricing it at the moment for you. And then in year 2, 3, 4, that's when once you've seized that ROI, you've showcased it to them, then you sort of change the pricing model, but it showcase that it's fully aligned to that end customer.
Hey, thanks for the time. I'm curious how you think about founder GP fit, especially in the early stages. And the reason I ask that is like the numbers may look good on paper, but how important is it for you to actually like each other, right? And how do you filter for investors that not only are you matching their thesis, but they're actually interested in forming a win-win with you?
Anupam, you want to take that?
Sure, yeah. I'd say it's a really key part. And especially, I think it depends on the model of the venture firm. So our model is we work closely with the founders, and we do relatively few investments. So hence, it becomes even more important than it would be otherwise. And life is short. You've got to spend it with, and the best outcomes come from actually working together in a way. So typically our process, I'd say, takes somewhere between 2 to 4 weeks to get to know the founder and the market really well. And during that process, you get to realize that can you work together. And that doesn't mean everyone has to fit a certain mold. So we have a variety of founders who may be very different in personality types, but I think there has to be some level of common ground in terms of a working relationship.
Yeah, the length of time you spend with a GP is higher than the average length of a marriage. So better pick the right GP. Next question.
And divorces are really, really hard. If you invest in the wrong founder, that's a very expensive mistake in our business.
Thank you so much for these insights. I was wondering, in your experience, given that there are so many new companies in every category and new ones coming up for a very new company, new startup, what do you see that works well when you want to differentiate and stand out, especially when you want to get those first few customers, when there's a category full of competitors with different tactics and strategies?
Who wants to take it?
In my experience, a founder who understands the customer better than the customer understands themselves. A founder who has spent time with customers, the actual users, the actual buyers of their product, in a way that they are deeply insightful about what that customer is actually thinking and feeling. That is when you truly get amazing companies, products, and technologies get built. But you really have to put your every ounce of energy into doing it. And I tell founders, you can never spend too much time with your customers and users.
Great.
That's when magic happens.
Great. Well, I think we can wrap up with the last thoughts here. Let me start with Ashmeet. Ashmeet, tell us, what are you bullish about, right? As now we're going to the AI era of go-to-market and customer acquisition. So tell us, what are you bullish for 2026?
In particular, so firstly, I'm very bullish on AI. I think most people would agree it's a very important technology. It's going to have a huge impact. In particular, what I'm very bullish about AI is that it is changing our interface with the computer. For various reasons, what has happened is that the interfaces have been owned by specific companies, and you tend to get controlled by those companies. So if you want to do search, you're pretty much stuck with whatever Google decides that you want to do. With AI, the search paradigm is going to change. If you were going to build an interface, you were pretty much stuck with what Microsoft or Apple were going to do. With AI, that interface is going to change. So I think it's an incredibly exciting time because AI is enabling us to create entirely new ways of thinking about how we work with technology, and that's where it is going to be tremendous opportunity.
Absolutely. Anupam?
Yeah, so I'd say, within enterprise AI, it feels like the last couple of years have been years of experimentation, where there's so much new stuff coming out, everyone's trying things. It feels like we're getting to a stage where things are really hitting critical mass in terms of actual value that is being delivered. So I think 2026 is going to be a big year for that, of a lot more things going into production, wider across every business function, every vertical. And it's up to all of us to deploy it in new ways. And I think business models, use cases, verticals, industries, all of those are up for experimentation and applying new things. So really excited about that in 2026.
Absolutely.
Yeah, I'll add on to that with a slightly different lens. I'm really excited. As VCs, our job is to make investments, and then we only make money for our LPs when those investments exit. So I'm actually really excited for the exit markets in 2026 and beyond to hopefully really open up on the M&A side, especially as you're seeing a lot of these strong vertical SaaS players of the last decade. These are companies that actually do need to add on a lot of AI native products across their stack as they're up-leveling themselves, and that creates a lot more liquidity in the venture asset class as a whole.
Well, thank you. Let's give a big round of applause to the speakers here.